We did have an incident where there was it was a London stockbroker actually, where we'd done a review with a client on the cover and discovered that they needed quite a bit more cover, which required a GP report. We went for a GP report, we chased the GP, the insurers chased the GP, the client chased the GP, and after 6 or 7 months, we still didn't have it back. I got an unfortunate call from the client about a month after to say they'd been diagnosed with a brain tumour. So due to the negligence of the GP surgery, it meant that the client couldn't get that cover.
Wow.
But it did go further than that, and the surgery was found liable, and the family was rewarded some quite hefty compensation.
Hello, everybody. Welcome to the Mouthy Money podcast. I am joined, as ever, by my good co-host, Chris Tuite, who is Head of Consumer Finance at PR and Marketing Agency MRM. Chris, hello.
Hi, Ed. How's it going?
Yes, very well, thank you. I've got a really good subject for you today, and this is something that we've, over the course of the summer, for those keen-eyed observers of the Mouthy Money newsletter and website, something that we've been working on building up a little bit more knowledge and understanding about for our audience, and that is the theme of protection. Now, protection, Chris, it's one of those sort of buzzy industry words that I think if you were to say it to somebody in the street, tell me what protection is, they would probably
They might say something else, Ed.
Yeah, like a bodyguard or something like that, right?
Well, I was thinking something a little more salacious, but there we go.
Yeah. Chris, you've taken us down a bad route already.
I'm here to drop the tone down. What can I say? There we go.
Bonus set.
Okay. Let's make this so protection. What is protection? I'm going to explain it very quickly now. We're talking about a sort of constellation of different financial products that protect you against, basically against some kind of disaster. That disaster could be, not to put finer point on it, if you die and you have family who would suffer without, the income that you bring to that family. Then other policies such as income protection, where if you fall ill and unable to work, will provide you with an income if you're not able to get a salary, and a few other different kinds of policies. Now, these are all insurance policies. We've got somebody who knows basically the ins and outs of this whole area of finance, and we're going to talk to him today about why you need protection in the financial sense. So I'm very happy to introduce Dale North, who is Chief Executive and founder of Pure Protect, which is a specialist protection broker. Dale, welcome to the podcast.
Morning. Thank you, Ed. Hi, Chris.
Hi, Dale.
Now, Dale, I hope my slightly haphazard explanation of what protection is was okay there, but just tell us about your background. Tell us about Pure Protect and how it came about and what you guys do.
Yeah, absolutely. I think you're fairly spot on, really, with your description of protection there, Ed. I mean, I've been very passionate about protection for a long time, and I first got involved with protection around 14, 15 years ago when I was actually an IFA, and found that this area of financial advice I was very, very passionate about. So we decided at that point that we could do a fantastic job for clients, and we set up the business Pure Protect back in 2011, 2012 to help consumers get the right products that they need. So in terms of protection, what we're talking about really, as you said, Ed, it's putting advice in front of people on these products that if issues arise, whether it be, as you say, quite bluntly, people passing away, they get critically ill, they're off work, long term or even short term, there's some financial protection in place to support them and their families. Because without that, and the way that benefits work in the UK currently, the majority of families would be in a real sticky situation should one of those things happen.
Yeah. And as I mentioned at the top there, this is something we've wanted to really kind of look into as an area more on Mouthy Money. And the reason that is because actually, when you look at kind of millennial cohorts, so people who are my age, they really are now the people who are buying homes, starting families, are in probably the best years of their career in terms of earnings. You go into those kind of golden years in your 40s and 50s, don't you? Where that's kind of when you're earning the kind of the highest amount you're probably going to earn in your whole career. And these are the kind of people who really need to think hard whether they should be taking these products on. Now, it's quite common when somebody buys a home to be referred to get advice on protection. Is that right? That's probably the first point at which somebody's going to come across something like this, isn't it?
Yeah, that's where the majority of our clients come from, Ed. So we have a referral relationship set up with several financial institutions, building societies and networks where they will do the lending on products but don't have the expertise or the time to do the protection advice. So they refer those clients across to us. So typically for us, a client it could either be a single person that's purchasing a property. It could be a family 2.4 kids that are, again, moving into a property, or even just got round to reviewing the cover and want some advice on what sort of products they should have. So, I mean, talking about the products quite broadly, I mean, the most simple one that you see the most sales on this product within the UK is life insurance. And where mortgage brokers are doing the protection themselves, quite often that's what they'll be doing. And they'll be going in with a quotation for covering that mortgage that the family are taking out on life and maybe critical illness. But with protection, it does get a lot broader than that. And in the UK, I think most IFAs would advise that families would have at least 6 months worth of income sat in easy access accounts that they can get access to should something happen. And I think with the way that the rates are still quite high in the UK at the minute, people don't have a lot of spare cash to be saving. The price of things that have gone up since COVID have been quite significant. So I think that leads on really, really specifically to income protection, and that we've seen a huge increase in the amount of inquiries. And also there's been a higher education of clients on income protection since COVID periods, because most people, as I say, don't have those savings in the banks. If something were to happen, you've got to ask that question to those people. How are you going to be able to pay for your food, your holidays, your mortgage bill, utilities, should something happen? Because I mean, on income protection now, the average, I'm going to ask you guys, do you have an idea of what the average claim period is on an income protection policy these days?
Oof, I couldn't tell you.
I don't
No
either.
idea.
I'm going to guess and say 3 months.
Okay, so most people think those sort of periods, and people imagine, don't they? If they're off work sick, yeah, they might be off 1, 2, 3 weeks, maybe 3 months, but the average claim period on income protection is actually between 7 and 8 years. So I know, and there's actually there's an income protection policy with one of the major insurers that's been going for near on 45 years now. So it goes to show that people's perception of what they think they might need and what they actually do need can be vastly different, and that's why advice can be really, really important for those people.
Yeah,
I think it's really fascinating on the COVID thing, Ed. Sorry, just to jump in.
Yeah, go on.
I'm going to bring it back to myself, Ed, as I always do, about this. But I did take out some protection policies. I'm, sensible financial person, as you know, about 11 years ago. And I had a look at all 3 types. So the first was life insurance, because my wife and I were getting a mortgage on our first flat. And we got a product that, as the mortgage debt ticks down, then the sum assured ticks down, meaning if something happens, it will pay off the mortgage in full. And then as we go, that number sort of ticks down. So I was like, that seems sensible to me. And then we looked at critical illness. What are the likelihood of one of us falling ill and needing to take some time off work and having some kind of support in there? And if you look at the stats around critical illness, particularly things like cancer, it's even though we were quite young at the time, it's worryingly high. So you think, well, the chances are, I think it's 1 in 2, isn't it? Or 1 in 3 people who are going to end up. So, that to me feels like it's a high probability that's going to happen potentially. So it's in some way, shape or form. So decided to take that out. And then the last one was the income protection piece. And I'm really fascinated by this, because my thought process at the time was, I don't want to get another policy. We'll save, it'll be fine. And then COVID hits, and you suddenly realize that there is quite fragile, all of this infrastructure that we have around ourselves in terms of, being employed and benefits from the government and all that kind of good stuff. And it kind of made me realize, at least, that this very much could happen. The worst can happen, and you do need to prepare for it yourself. So I'm quite interested in the mindset shift, because I think there's been quite a spike in income protection policies that have been taken out since COVID, and maybe other people have been on that similar sort of thought process that I've been on, which is the worst can happen and does happen, and therefore you need to have a plan for it.
Yeah,
I think there's a really interesting behavioural thing there as well. Dale, I would love to hear your kind of experience of this with clients. And I know like Silicon Valley kind of business types, we'll call it that kind of Netflixization of society, where everybody's happy to pay a subscription to something, and because everybody gets paid, and this is like Something that I think doesn't get talked about enough is that how people's lives very much now revolve around their monthly salary and organizing their life around that salary, right? It's very hard to save 6 months of your income up, but it's not that difficult to maybe pay, 50 quid or whatever it is a month towards a protection policy, because it's easier to budget that out on a monthly basis. And for me, that erosion of savings post-COVID makes this more attractive as an option. And this is actually something I've done. I've taken out income protection because I found it an affordable way to do that instead of having to nurse a rainy day fund. That actually, that cash for me is more useful elsewhere, like buying new windows for the house or something like that, So that's that's how I feel. Like, Dale, do you have this, experience with clients and that ease of the monthly payment?
Yeah, definitely. And I think that the good thing about income protection is it's so flexible. Yes, in an ideal world scenario, you're going to cover your net income up until the point you retire. But we don't live in an ideal world scenario, and not everybody's got 100, 200, 300 pounds a month to spend on protection. So with income protection, you could take a full quote for somebody, let's call it 120 pounds a month. You can look at altering the expiry date of the policy. You can look at changing the deferment period. And what a deferment period is it's the point where the policy is going to pay out. You might say, let's say you're employed at a blue chip company and you get 6 months full sick pay. Obviously, you'd have an income protection policy to kick in after those 6 months have ended. Now, for an insurer, the longer the deferment period, it's the better for them, really. So it's going to mean your premiums are going to come down. So you can take 120, 150 pounds a month income protection policy, and by altering some of these factors, you can bring it down to 20, 30 pounds a month, because we also do what's called short-term income protection. It's been around for a very, very long time now. So what you ideally want, when we talked earlier about the average claim period is 7 or 8 years, what you really want is a policy that's going to cover you up until the point of retirement, cover that 7 or 8 years. But, and again, not always affordable. So there are short-term plans available. There's 2 years, there's 3 years, there's 5-year income protection plans available. So it is really, really flexible. And that's why advice is so important, because say a consumer going online and just thinking, right, I'm going to buy my own protection, looking at income protection, do they know to think about if there's going to be short-term plans on there, and just quotation on a full one, look at it, it's too expensive, then put it in the drawer and move on to the next thing, like purchasing the windows or whatever.
Yeah.
But just coming back to what Chris was saying, I think, Chris, you're a perfect example of what most consumers do in the UK, really. So where you talked about you bought your life and your critical illness policy to cover your mortgage, fantastic that you've done that. But there's another really, really important product for families in the UK called family income benefit. And when you look at the majority of the protection we said earlier that's sold through mortgage brokers or advisory mortgage brokers is specifically to protect that mortgage. But when you look at the claim stats and what people actually do with that money, less than 8% of people that receive a critical illness payment actually use it to repay that mortgage. So that tells us there's a far greater need. And when you again look at mortgage payments is maybe 20, 30% of somebody's income, where's the rest of that income going to come to support them? So there's been a product available in the UK for a very long, long time, but it's not widely talked about, and that's family income benefit. Basically, on family income benefit, you can cover yourself against death and critical illness, and it pays a monthly income or an annual income in the event of those things happening. So you can have a scenario, if somebody's fully protected, if something happens to one of those people, you can have the critical illness payment to repay the mortgage. Fantastic, that's gone, that saves some income. But then you can also have your critical illness payment being paid through, say, monthly or annually, or you can even take it as one lump sum to pay for those other things. We had exactly that with one of our own clients, where we wrote a life and critical illness family income benefit policy just last year, actually. A lovely lady who had a solicitor business up north, didn't have any previous protection, didn't know about family income benefit plans. She'd had a couple of previous ailments, which doesn't mean people can't get cover, but sometimes it might take a little bit longer. So we proposed to this lady to have a monthly income life and critical illness family income benefit plan. Took 6 months to go through underwriting, which is quite long due to medicals and obtaining GP reports and things, but we got it through for her. And then we dropped out a call and an email to the lady 1 week after the policy got on risk and couldn't get hold of her, unfortunately. So we tried again. And then about a month later, she dropped us an email and said, yeah, thanks for the emails, but unfortunately, a week after I'd taken the policy, I was diagnosed with a stroke, and I've been in hospital ever since. Thankfully, she's recovered really, really well. She's fully back to how she was before. But what it meant was she made a claim on the critical illness plan. It was successful. So she's now got £50,000-60,000 a year of net income coming into our household due to taking that policy. And there's no waiting period for things like critical illness on critical illness plans. Policy been, say, in force for literally a week, had a stroke, policy pays out. Herself and her family are now far more financially secure, meaning that she can take her foot off the gas, let somebody else partly run the business, and look after what's most important.
I think that raises one of the really interesting points, actually, as well. And this is probably one of the criticisms that when I kind of look at this area, you see come up and again from people on the consumer end of it. So people who, looking at whether or not they should buy a policy, is that criticism of insurers, like looking for ways to not pay out. And I'm pretty sure that's a myth for the most part. Is that right?
Yeah, I think it's a good question, Ed. So the claims rates on policies have got significantly better over the years. If you look back at critical illness plans when they were first released, they weren't as good. But now insurers, you'll publish their stats every single year. And on life now, the majority of them, they're around 99%. And we deal with the claims ourselves for clients because quite often somebody wants to deal with a broker, the person that set them up the policy when dealing with a claim, as well as the insurer. And the only reason that policies don't pay out is down to non-disclosure. And that goes back again to whether people should be buying these products direct or whether they should be taking advice. Because for one, when you're taking advice, you get the protection of the regulation through that broker. But it's about disclosure. So if I'm asking you a question, Ed, and I'm maybe asking if you smoked in the last 5 years, and you give me a response, oh, well, no, I don't think I have, Dale. So I will then prompt you on that and say it's quite important that I know specifically, because if there's a chance that you might have smoked in that period, then we need to disclose it to the insurer, because it would be classed as non-disclosure. The policy wouldn't pay out. Now, imagine if you're doing an online application direct to an insurer, you've gone through direct to an insurer through an aggregator. Are you going to think about how important it is? You need somebody in front of you to tell you that it is vital the information is accurate and correct to make it work.
Yeah.
So yeah, it's a big still a big issue in the industry, but more in non-advised direct sales than it is in advised sales, I'd say.
That's really interesting. I mean, I actually had personal experience this a couple of years ago when we bought our home, and our mortgage broker referred us through to a life and to a protection broker. And what actually happened was I went through the entire process, and I ended up speaking to. Actually, what happened? I didn't go through the process with the broker because they wouldn't leave me alone, and I got really bored of being nagged by them, and then I ended up going direct to an insurer through the aggregator, online, like you said. And actually what happened in the end was they told me if I would proceed the application, I'd get turned down because I was too overweight to qualify for the policy. And they're very honest about it. I ended up doing a whole thing about it on Mouthy Money. I'll put a link in the notes to the show. That threw into a kind of real sharp relief for me, like my health is not in the right place for what I want, to be able to protect my family. And actually, to give everybody the exclusive, I am now below the weight that they said was the limit, because I actually went out and did something about it. But
climbed
I think
the mountain, Ed.
I did. I climbed Kilimanjaro. Yeah.
There you go. So that's one way of doing it. Most people join the gym, but Ed climbed Kilimanjaro. Everybody.
I spent those policy premiums on a nice tour to Africa, basically. No, look.
Did you disclose the mountaineering though?
No, look, the point I'm making here is that obviously that drove me to make a lifestyle change. But I think your point, Dale's really important, is that you need to get this right when you go through the process. And that's why speaking to a broker matters. I think the next question I probably had in that case for you, Dale, was what is the potential cost associated with it, and who bears the cost of your services? Does somebody pay you for the advice, or do you get a commission from the businesses that you work with?
Yeah, it's a good question. So no, we don't charge any fees at all. So our process is that we'll fact find the client fully, we'll understand your needs, we'll match those needs to products that we first line feel that you should have, and then second line it'll be down to what is affordable and important to you. So we always start at the the top really was saying, in an ideal world scenario, this is what you'd purchase. However, you maybe want to allocate £80 a month to it rather than £300 a month to it. So then we discuss what's important. Our fees effectively are covered by the insurers that pay as a commission. And they vary from an insurer to an insurer. But when you're dealing with a broker, what is very important that you're dealing with a broker that's got access to either the whole of market or lots of insurers. Because as you talked about earlier, you went to one specific insurer that declined you on BMI, but different insurers have different stances on different medical and lifestyle issues. So that's again where it's very, very important using an expert broker that knows where to place cases, because somebody doing that online is not going to have the expertise. Even if they're using ChatGPT to say who's the best insurer for my BMI, might give you some light guidelines, but it isn't specific enough to tell you exactly which insurers you're meant to be using.
Yeah, that's on the cost thing. Obviously, people, I imagine, are pretty cost conscious these days. What is I mean, this is a very big ballpark figure, but what are, and so what are the typical costs that people can expect, and what sort of variables will change that cost as well? Because I know there's things like, as we mentioned, health calculations that will go into it and that kind of thing. Is that right?
Yeah, so for a family cover, our average is £85 a month, which can seem like a lot of money. So, but when you look in comparison to what people are now spending on food, and on home insurance, even looking at home insurance has increased 200-300% in the last sort of 5 years. The financial protection products have stayed fairly stagnant in terms of rate. So I think over the period since COVID, they've got better and better value.
Dale, sorry, just on that, does that product cover, what does that cover? Does that cover life, critical illness and income protection, or what's the...
So yeah, that's taking a client that's covering all of those. So it would be life and critical illness for the mortgage, it would be family income benefit for the family, and then income protection as well. But there's lots of different variables within there. And it depends obviously on somebody's age, their health. It depends on what's the size of the debts that they're trying to cover, the salary they're trying to cover on the income protection. Massive variables. For an individual person, generally, if somebody hasn't got any dependents, it might not be advisable that they take life cover. It's probably more advisable that they're looking at income protection first and foremost, and then critical illness, because if there's just solely one person there and let's say they get something horrible like cancer and they can't work again, then the state only goes so far in supporting you. So for an individual client, the premiums come right down to maybe £35 a month for a policy as an average for those.
I mean, that's really, I'm not surprised. I mean, obviously this is going to vary in people's experience when they go through the process, depending on what their needs and this kind of thing varies. But that, I mean, it seems a lot more reasonable than I might have imagined. It's not, this is the kind of thing that people will freely spend on a subscription to Sky or whatever,
As I discovered on the weekend, that's about 3 pints.
What, the Oasis gigs, Chris, that you keep going
Yeah,
to?
it was £10 for a Budweiser. I'd rather have the mix of offers that Dale's offering there, frankly. But there you go.
I think yeah, go on.
I was just going to say, Ed, I think another really important thing when people are looking at picking their own cover or taking advice is the sums assured that they feel that they should take. When you look at the amount of people that put in figures into aggregators and they think, well, I need to get some protection to cover my family because I've just had a baby, normally they'll be punching in figures of maybe 100,000, 200,000. When you run an analysis really and look at how much it costs to bring up children, how much you spend each year on all of these things we talked about, like your utilities and your food and things, £100,000, don't get me wrong, is a lot of money, but it won't go very far if one of you passes away and you need to support the family up until the point of them becoming independent, really. Because that's ideally what you want as a family. If one of you passes away, you want to have enough income coming in so that you can say to your kids, I'm going to be here for you. I don't need to be rushing off to work, flying around the world, whatever I'm doing. I'm going to be solely here to look after you. And that's another great advocate of taking advice and family income benefits specifically.
Yeah. And it can be quite, I mean, this, my own experience was this as well, is where you have kind of two earners in the family and actually one of the earners is probably potentially earning quite a bit more than the other. So there can be a disparity there, can't there? So it's important to ensure that you're insuring the right person to the right level too, because, I think my wife probably wouldn't mind me saying, if we didn't have my income, it would affect us more than if we didn't have hers to be, she's a nurse, she's not on a huge amount of money kind of thing. So there's differences in that as well, isn't there?
Yeah, there is definitely, and specifically in income protection. I mean, you can cover yourself up to sort of 65% of what your income is. But where we talk with couples where maybe one person doesn't work and the other one is the main breadwinner, sometimes people can say, well, it's not so important to insure me because I don't earn so much money. Well, it is really important, especially if you've got a family, because if something happens to that person and that other person can't do that job anymore, where they've been taking home £3,000 or £4,000 a month, that could potentially go. So that's again why it's really important to look at it really technically and cover people for the correct amounts.
Yeah.
Dale, sorry to cut across. Dale, Ed mentioned earlier that there was a broker. One of the reasons he went direct previously was there was a broker who wouldn't leave him alone. For people who might be convinced by what we're saying here and thinking actually this might be a good idea, what's the typical process like? How long does it take? You mentioned previously with that lady with the solicitor firm up north, it took 6 months and that was longer. If someone were to speak to you tomorrow, who would they, what's the process? How long does it tend to take? I know there's loads of variables, but can you give us an idea of what a typical journey might be?
Yeah, of course. So if somebody gets in touch with us, we have a 2-hour SLA to get back to them and get an appointment booked in. So we've got several advisors all around the country. So we will give people the option, really. We don't do very much face-to-face these days, not because we don't want to do it, because it doesn't really have much of a call from consumers, but we'll offer telephone calls, or quite often now we'll do a lot of Teams calls as well. So we can show people on a Teams call the quotations we're running through the portals and disclosures and things like that. But another important thing we'll do as well is we will take people through risk calculators, Chris. So it's all right us saying to people that, yeah, these products are really important, but we've got risk calculators where we can put in people's ages and demographics, and then it can tell you what your risks are of these things happening. So seeing it real world, truthfully, is really good. So in that part of the process can take maybe the fact finding 35 minutes, 40 minutes, something like that initially. And then it depends on how complicated the case is, whether sometimes an insurer can offer terms straight away. We would always like clients to have some time to think about what we've proposed to them. So once we've done that first call, maybe we've run through some quotations on the Teams call. We'll then send the proposal over via email generally to those people. Say take some time to think about it, book them back in to go through applications later. And then if it's probably 45-50% of applications, Chris, will go straight on risk. So we'll get terms offered straight away. Things that lead to medicals and GP reports can be higher sum assureds, or it can be some medical disclosures maybe that you might not know fully. So you need to get the GP to send some details to the insurers, which incidentally the insurers pay for all of that work to be done. So it does vary, but I'd say probably 40-45% of people can get cover offered straight away. And I think with our expertise, that can be a lot quicker because we know from people's medical histories which insurers to go to. Quite often with some people maybe that aren't specifically experts within the protection field, they might go to the insurer that they feel is the least expensive, not knowing that after 6 months worth of GP reports are not going to accept them. So it's done as swiftly as it can be with the tools we've got to our disposal.
Interesting. So it's not as painful as potentially you might think, by the sounds of things, if you're doing it instantly. With technology and access to GP records and things like that, you mentioned the insurer pays for that work. So who would approach them? Would the insurer, would you just give permission for them to contact your GP, or would that be something that the person who's trying to take out the policy would need to do?
Yeah, it's exactly. So if somebody's got a really complex medical history and they might have a load of information already, so we will say that if you've got documents that have come through from an operation or something, if we can have those up front and start talking to insurers before we've even applied, because last thing we want to do is taking you through applications to go to insurers where it's not going to be accepted. But yeah, the process will be that the insurer will get the authorization from the client, or we will, and then they'll send out for a GP report from that GP surgery. Now, don't get me wrong, it can be quite a lengthy process depending on the GP surgery, but there's an obligation for that GP surgery, obviously, to complete that as quickly as possible. And at the end of the day, they get paid for it as well. But we did, probably about 8 or 9 years ago, we did have an incident where it was a London stockbroker actually, where we'd done a review with a client on the cover and discovered that they needed quite a bit more cover, which required a GP report. We went for a GP report, we chased the GP, The insurers chased the GP, the client chased the GP, and after 6 or 7 months, we still didn't have it back. I got an unfortunate call from the client about a month after to say they'd been diagnosed with a brain tumour. So due to the negligence of the GP surgery, it meant that the client couldn't get that cover.
Wow.
But it did go further than that, and the surgery was found liable, and the family was rewarded some quite hefty compensation
Extraordinary.
to do what should have been done in the first place, really.
Yeah.
Wow.
So yeah, not to scare people about how long cover can take, but it
No.
but it's the reality of it that it can
Yeah.
take some time. It can be quite.
That's I think that's an extraordinary story. But I think what it really underlines here, and this is from my personal experience now, recently having dealt with a couple of admittedly minor health problems, and I'm in my and the thing you don't realize when you're young and fit and healthy is that this stuff can come out of nowhere, right? And if you don't have your health and you're unable to care for your family, I mean, it can be devastating emotionally, for your kind of social welfare, and obviously, in the context we're talking financially, it can be devastating. So, I mean, I think my real takeaway is if this sounds like you, if you're young, and you feel like you're invincible, unfortunately we're not, right? We're not invincible, and things do happen. And as you said, you guys have got the graphs to prove it. Unfortunately, we don't have those in front of us today, but it does happen, and anybody who's in that situation really needs to think carefully about their needs, right?
I think the other thing as well, sorry, Dale, is it's not a one and done. So you mentioned, that's probably worth touching on, because I feel like my protection, I took out a critical illness cover that about 11 years ago that I decided I didn't want linked to inflation because it was a little bit more expensive. And I look back on that now in light of everything that's gone on and think that was a bad decision, because I look at the sum assured now and the amount that I would get if that were to happen, and I don't think it would cover half a year of recovery time. So Dale, you might be getting a call from me looking to review that in the not too distant future, because it doesn't feel fit for purpose. The life insurance does, but that doesn't feel right for me. And my circumstances have changed. The world has changed around me. So it can happen to you, but also you need to be aware of the risks as you move through, I suppose. Is that fair, Dale?
Yeah, that's a really, really good point, Chris, because reviews are so important. And again, if you are arranging your own protection, or quite often you've gone through maybe an intermediary that does other things as well, they might not be as focused to be doing reviews with you. So with all of our clients, we go back and offer reviews at least every 2 years, because we find that generally after a 2-year period, something has changed. Now, it might be that your family is now a larger family. It might be that you need to change your trustees on your plan. We've not talked about trusts, but I mean, trusts are obviously vitally important to any life insurance policy to make sure that it's going to avoid inheritance tax and going to go to the right people. But it can be income protection, for example. You might have moved jobs. You might have had salary increases. It could be that you were a smoker and you're now a non-smoker, so you can get a much more favourable rate. And then you go on to also insurers as well. How much have insurers changed in the last 11 years since you got your plan, Chris? So we've got technology. We can compare your critical illness plan of 11 years ago to what's available today, and we can tell you quite specifically whether today's products are better or worse, and advise you accordingly. So reviews, whether there's people listening to this that think, well, that's fantastic, we've got cover, fantastic, you've got cover, but please do get it reviewed at least every couple of years. Look at your whole circumstances with a specific advisor, because we know on our reviews that it's over 50% of the time when we do that 2-year review, something has changed, and we advise a change to that policy, whether it be in an amendment or a replacement of that plan. So it's becoming a big subject, I think, for the regulator going forward through the reviews next year, that reviews should be undertaken by advisors that have advised previous plans.
Just quickly on that trust thing, Dale. So mine is held in trust, but I don't think I fully remember what that means. It's probably worth taking. So if you put it into a trust so that if the policy pays out, that it won't be subject to inheritance tax. Is that correct?
No, it is as simple as that. It's a life insurance trust is a very, very simple trust. The statistics, when you look at it in the UK, the amount of people that take life insurance and don't put it on trust is quite shocking. And that is also in the advisor community. Everybody should be putting their life insurance policies into a trust, and there's a specific reason why not. And if you haven't done it at inception, doesn't mean that it's lost and you've got to buy a new policy, you can put existing policies in trust as well. But what it basically means, Chris, is if something happens, the trust will be activated, and then potentially it will avoid the inheritance tax, which is obviously quite a hot subject in the UK at the moment. But also, probably more importantly, it's going to speed up payment. So if you're waiting for probate, when you look at the waiting list for probate at the minute in the UK, you could be waiting six months to a year for people to get that money. Imagine it's a family, they need that money right now. It's that the income is stopped from that person straight away. So it will speed up payment drastically. And with the trust being activated with an insurer, you would expect the money to be with the recipient within a month, which is needed. And they will even, some insurers, advance even quicker than that. Immediately they'll start sending money for things like funeral costs and what have you.
Is that something you guys set up from the outset there? Was that something you guys could do for?
Yeah, so if you went to a solicitor and asked them to set up a trust, then I have seen quotations battered about in the past between £800 and £1,000, but we don't charge for any of the trust work that we do. And we actually also offer a free trust service to existing clients where we review the cover. If nothing needs to be changed, even though they're not bought the cover from us, then we can set the policy up in trust. It's so easy to do. There's no reason not to do it. But when you are arranging a new policy, it's generally part of the application now. You'll be asked, who do you want to allocate as trustees? Who do you want your beneficiaries to be? And it's done straight from the application. So that's the best way. Nearly all insurers now in the UK market will accommodate that.
I think inheritance tax is perhaps a can of worms that we're not going to open today.
Probably wise.
You don't have to, because if our policies are in trust, Ed, that's it.
Exactly. No problem. Jobs are good. And sorry, Rachel Reeves.
Yeah.
See you later. No, this is it's been really interesting, Dale. I think, the key message here for everybody is, and we bang on about having a plan, making a plan, but this is what you need when plans go wrong, right? This is your backup.
Contingency planning, right? It's the same as having a positive plan,
Yeah.
Correct.
And I think that's really important. So I think, Dale, with that, I'm going to say thank you very much for enlightening us a bit more on protection and why you need it, why everybody should look at it. So thank you.
Thank you, Ed. Thank you, Chris.
And thank you, Chris, as ever, for sharing your side of the story.
Pleasure. My pleasure.
And thank you, everybody, for listening in. This has been a really great discussion. Thank you for tuning into the Mouthy Money podcast. Don't forget to hit like and subscribe on all our content. Follow us for more on your preferred podcasting channel, including Spotify, YouTube, or Apple Podcasts. Stay in touch by following our social channels on Instagram, TikTok, and LinkedIn. And don't forget to subscribe to the Mouthy Money newsletter on mouthymoney.co.uk. The Mouthy Money podcast is produced for general informational purposes only. It should not be construed as investment, legal, tax, or other forms of financial advice. If in any doubt about the themes expressed, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up, and you may get back less than you started with. Never invest more than you can afford to lose. For more information, visit fca.org.uk/invest smart for more. Thank you.